Thank you for joining us today. I'm really excited about our webinar topic for this month. It's a topic we get a ton of questions about. We know there's a lot of kind of misinformation and aggressive sales tactics out there around this. And so this was another topic that was recommended by our newsletter audience. We did a poll a while ago, and this had the second most requests for topics for us. And it's just a high-level overview of annuities. And so what we're going to do is do a very brief review of the different types of annuities, but then really get into kind of arguing against some of the main sales points that are made when people are trying to sell annuities to people, specifically the idea of tax deferral that you get from annuities and how that's a big benefit. We'll get into a little bit about fees, the fine print on annuities, and also some alternatives too, just so you know what to expect. So in general, what is an annuity? This can be incredibly complex. We'll see in a sec here why this is really hard to give a specific answer to. But in general, an annuity is some kind of contract that you have with an insurance company that's going to provide you either some sort of defined growth on your investments or guaranteed income. I bolded insurance here, so just understand that these are insurance products. They are not, investment products per se. They are insurance products. You're signing a contract with an insurance company when you buy an annuity. And anytime you start to get an insurance company involved, know that there are fees. And so annuities have a few different fees that, regardless of any of the types that we're going to talk about in a sec, you should find out if this is an annuity that you're considering. There's some kind of base contract fee. There's some kind of underlying investment fees. And then, depending on the options, how complex these annuities get, there can be lots of other fees on what are called riders for annuities. We'll look at a couple examples of these in a sec. But just to give you a very brief overview of the many types of annuities that are out there, I think of annuities as kind of two different categories. There's income annuities, and these are kind of the classic sense of just turning over a pile of money and getting income for life, that monthly payment for as long as you live. The really popular types of these income annuities are SPIAs, or single premium immediate annuities, or there's a little bit of a wide range of different types of deferred annuities. One is the qualified longevity annuity contract, or QLACs. And for those of you that are regular attendees of our webinar, a few months ago we did a webinar on the two types of annuities that we would recommend, and that was about SPIAs and QLACs. And so these income annuities are one, again, kind of type of annuity in my head. The much more popular type of annuity is what I'm calling here investment annuities. That's not an official term by any means, but I'm trying to group together different types of annuities that are really sold on the prospect of you saving into these over time and you getting that tax deferred growth, where then eventually, sometime in the future, they'll try to pitch you to annuitize it or turn it into an income annuity. But these investment annuities are the vast majority of the annuity industry and they just have different calculations for how the investments within them perform. So fixed annuities, these can be very similar to like CDs. Variable annuities can be very similar to like a brokerage account. You're actually picking mutual funds within the annuity to invest in. Indexed annuities are kind of the more complicated version here. And there's some kind of benchmark, and they're applying some kind of cap and a floor to returns. And so it might, for example, be an annuity that's indexed to the S&P 500, but you only get the first 8% of returns, but you can't lose money, just for example. Again, really complicated. One annuity that we'll look at here later on, the prospectus for it was 108 pages long. And so just that's my caveat here of saying each of these types of annuities has hundreds of pages of details about it. So we can't get into the specifics of every single type of these here. But just to give you a sense of what the annuity industry looks like today, there's about $385 billion in annuity sales last year. That number's been growing very fast. 2024 very likely could be higher than that. And then I put here just how that is broken down in the different types of annuities. And again, what I want to highlight is that this kind of top category, what I'm calling investment annuities here, is the vast, vast majority of annuities that are sold to investors today. And so what are these annuities sold on? They have a few benefits that you'll find on just about every single insurance company's website. I took a screenshot here of just New York Life's annuity page. This is solely because they come up first or second in Google, I think, when you Google annuity benefits. And you'll see a few big items that are highlighted here. Guaranteed income for life, tax deferred growth, and then a couple others as well. And, so the guaranteed income for life, we talked about this. This is on those income annuities. It is a very real benefit. There's a lot of academic research out there that having some amount of guaranteed or fixed income in your retirement is very important and very beneficial. What I would argue is that looking at the numbers on that previous slide, this is not how most annuities are sold. Remember, it was about 17 billion of the 385 billion in annuities are sold, for their income. Most are being sold on this idea of tax deferred growth. And so that's really what we want to spend the most time in this webinar kind of debunking, or at least showing you kind of the pros and the cons of what you get with this tax deferred growth. And I thought it might be easiest, to look at the idea of tax deferred growth to first start with what is an example of, non-tax deferred growth. What is this that the insurance industry, is saying is so bad here? You want this tax deferred growth. So what's the alternative? And the most simple alternative here is just looking at an investment in an ordinary brokerage account. And so this is an account you can set up at any of the custodians here. This is a non-retirement account. Brokerage accounts, you can put in any amount of money, not locked up for retirement. You can pull it all out tomorrow if you want. And so for this, I just looked at a very basic index fund that's out there, and considered $100,000 an investment into this. I put the fund here. I use this one because we're going to look at some Fidelity annuities in a sec. So I wanted a very similar comparison for investments. Fidelity offers this really great total stock market fund, invests in thousands of companies, very diversified, for an incredibly low fee. 0.015% is the fee on this fund. And so let's just assume here that this fund gets 9% annual growth. You put $100,000 into it today. What happens? You get that 9% growth minus the fee, of course, and a portion of that growth is coming from dividends. Today, as I'm recording this fund has a 1.2% dividend yield. And so you are going to get a payment of 1.2% of your value of that fund every year. And what happens is that if this is not in a tax deferred account, you have to pay taxes on those dividends. And so this far right column here is showing you your annual tax bill from that, what started as a $100,000 investment. And so you can see over time, these account values grow. This chart is assuming that the investment is sold to pay this tax bill. And so you In reality, we don't see this happening a lot with people, but just to be, completely fair comparison here, what I'm assuming is that every year for this tax bill, you're selling some of this investment. And so over time, you're getting what the insurance industry calls a tax drag here, just meaning that you're being forced to pay some taxes. A little bit of this money has to come out every year to pay that tax bill, and that causes a drag on the growth that you could get. And so what this looks like is over 20 years, again, assuming some of those growth numbers, your $100,000 would turn into about $540,000. And in total, over that 20 years, you would have just under $10,000 in taxes that you would owe to the IRS because of that. And so annuity companies love targeting this idea of, hey, you're going to pay $10,000 in taxes if you put this in a brokerage account. Here's a better way. This is a screenshot from some marketing material from Equitable, which is one of the largest annuity companies out there. And what do you see? They're showing you, charts of how tax deferred growth leads to these higher account values. You see that tax drag, verbiage here that they're highlighting. But there's some very key things that this marketing material, and this is not just Equitable, every annuity company kind of leaves out when they're comparing these annuities. And the most important one is factoring in fees. As I mentioned, annuities means you're working with an insurance company, and insurance companies don't work for free. They charge you something. And so I tried to find the lowest cost of an annuity out there I could find. I can't guarantee this is the lowest, but I will promise you that you won't find very many cheaper than what Fidelity offers. Fidelity's variable annuities have a base fee of about 0.25%, and then you can choose the investments within there. And I picked this fund. It is very low fee, but it's also very similar to what we were just looking at in that previous example, that Fidelity Total Stock Market Fund. And so I wanted some apples to apples comparison here that you'll see in a couple slides. But what do you see from Fidelity here? Annuities may be good if, and building wealth, tax deferred growth. That's what they're highlighting here is the benefit of this annuity. And so how does this look, $100,000 invested in this, quite honestly, better than average Fidelity annuity. And so here I show you have these fees on the annuity, that same growth rate that's assumed, but you have a little bit higher fees. And so your after, your kind of net growth rate is a little bit lower because now we're paying 0.36% in total fees rather than 0.015%. And so over those 20 years, you see that $100,000 investment grow into $525,000 or so. What the insurance companies are going to highlight is that your tax bill over that 20 years is $0. And a lot of people like seeing that. And, of course, what you may notice is that high fee means you have a lower ending balance. And so it is very true. You did not pay $10,000 in taxes over that 20 years, but you have less money. And so how this looks just kind of side by side here is we gave that first example of just that Fidelity Total Stock Market Fund in a brokerage account. Then we gave that same fund in an annuity, and we had these ending values here. But then what's more important to consider here is the tax impacts of these different types of investments. Brokerage accounts are subject to a different tax rate than annuities. Brokerage accounts get long-term capital gain tax rates, which for a lot of households is 15%. It can be as high as 20, but you'd have to be like a married household of well over $500,000 in income. And so most people find themselves at a 15% tax rate for this. And so that 15% tax rate would apply to the growth. And so remember, $100,000 of this was your initial investment, that is not taxed. So 15% on 441,000 is about $66,000. And so you should think of that brokerage account as having this kind of after-tax value of about $475,000. Now compare that to the annuity. So not only was that ending balance a little bit lower just because of the higher fees, but there's a penalty that, or not a penalty, but there's a trade-off that you have to pay for that 20 years of tax deferral. And that is that gains in annuities are taxed at income tax rates, not capital gains rates. And so at the very least, if you're in the 15% capital gains bracket, you are in at least the 22% bracket. You could be much higher, into the 32%. But just for kind of the best scenario here, I'll assume you're in the lowest tax rate possible. And again, you're paying 22% on, in this case, it'd be 424,000 because that initial $100,000 investment is not taxed. That means you have a $93,000 kind of tax liability if you're withdrawing this balance at 22% tax rate. And that after tax value here, we're seeing now much, much lower, 331,000 compared to that 475 for the brokerage account. And so here you see a very big cost of that benefit, and I'm saying that in quotes here, that benefit of tax deferral. And so I had mentioned that Fidelity Fund was one of the better ones I see. I wanted to highlight what is much more much more typical for what we see with annuity fees. And so shown here is a chart of the biggest sellers of variable annuities in 2023. And at the top of the list here, you see Equitable Financial. And I'm just showing this here so you don't think I'm showing, some off-the-wall annuity that is not something that is commonly seen out there. I'm showing an annuity from the biggest variable annuity seller here. So Equitable has their Investment Edge line of variable annuities. Again, they're highlighting that tax deferral, diversification that you can get. And if you look in the prospectus that they have to file with the SEC, they have to list the fees in there. It's kind of hard to find this on their website, believe it or not, but SEC requires it to be in their filings. And at a minimum, you have a base contract fee of 0.25%. And the cheapest investment option that they offer is 0.58%. This other fee here is kind of for some optional riders. We'll talk about that. But let's just say you pick the cheapest options here for their annuities. That's going to end up being a fee of 0.83% for you. And we're going to look in a sec. You should notice that 0.83, much higher than the Fidelity fees. You can imagine what this is going to do to your growth. It's a lot of money that you're going to end up paying to Equitable for this. And, just to throw kind of a fun number out there, if, we looked at 2023, Equitable sold about $17 billion in variable annuities. If everyone selected this minimum fee, that's about 141 million for them. I have a feeling a lot more people are in higher fees than that. And so these are incredibly profitable products for these insurance companies. But so now let's look at that same example. And now we have that same $100,000 initial investment, now with these higher fees. And so you're getting a much less growth over that 20 years. That fee is really adding up here. And so we're ending up with a total of about $480,000. Again, they would highlight that tax bill of $0 that you've paid over the in the end than a brokerage account. And so just doing that same comparison, remember that brokerage account had an ending value of about 541,000, after taxes about 475,000. Now this little bit higher fee annuity, we're talking almost, getting close to a $200,000 difference in value on an initial investment of $100,000. And so we just want to highlight this here to show that these companies spend millions and millions of dollars marketing the benefits of tax deferral. And for the vast majority of people, that does not come at an ultimate benefit. There might be a benefit in year 1 or 2 when you're not paying those tax bills, but in the end, you pay for that tax deferral in one way or another. And so, to give you an idea of what fees are out there for annuities, again, I mentioned there's that base contract fee. This is for any annuity. Know that that's going to be at least 0.25% and can very easily get well above 1%. So you're going to have that fee. In addition to that, you're going to have those underlying investment fees. Some can be very, very low. We know there's some Schwab annuities out there that have very low, 0.03% expense ratios on their funds there. There are some that are incredibly expensive, and I have seen a 4% fee in a variable annuity before, just on the investment fee. And so again, you can look here and see it's very easy to get 2% or more annual fees in annuities. That would not be uncommon to see. And then in addition to that, there's lots of different riders. Remember, these are just insurance contracts, so they like throwing in a lot more complexity if they can sell you on some other stuff. Things like death benefits. So, hey, you're saving into this. If you die when before you can annuitize this, we'll guarantee a certain death benefit for you. So it's kind of like life insurance combined with a savings vehicle. But again, they charge for that. Usually somewhere between 0.25% and 0.5% for each of these benefits that are available to you. You'll see some annuities offer like what they call downside protection, and that's just saying, if the market drops 10%, the value of your annuity might only drop 5 or 0. Of course, that means there's caps on returns too, and so that's something you should be really aware of. They might offer some flexibility in withdrawals. By default, they might only allow certain withdrawals. You can pay more to have some flexibility there. And I'm not going to limit it there, but these insurance companies are very creative. They can add lots of different options to try to entice you to buy these. And again, just know that everything is coming with an additional fee. And then finally, there's some other restrictions on annuities that are really important to understand before you'd purchase one. The biggest one, I think, is surrender fees. And so this is essentially a lockup. When you purchase an annuity, you have to check and see if there are surrender periods for this annuity. This is a screenshot of an annuity we saw from a client. And what this is saying is a percent charge if you withdraw your money from that annuity in a certain year. And so, in our $100,000 example, let's say this person put in $100,000 into this annuity and 2 years later wanted to withdraw all that money, right? They figure out they need the money for something. They would pay an $18,000 fee on that $100,000 to get their money out in 2 years. Or at least 18,000. Hopefully it grew a little bit, so it might be more than 18,000. Even 10 years later, 10 years after buying this annuity, they'd pay a $10,000 fee to get their money out. And these numbers can range. There are annuities that do not have surrender charges, and there are annuities that have surrender charges 15 years out. And so this is something you have to be really careful of and be one, very certain that you're comfortable locking in money for that long, but also just maybe find one that doesn't have that. You never know what the future holds, and having to take a 15-18% hit on your savings would really hurt. Besides surrender fees, there's one other big caveat to annuities, and that's that once you put money in an annuity, if you withdraw it before age 59 and a half, you may be subject to not only income tax, but also a federal tax penalty. And so essentially the government is making you keep this money in an annuity for a while as a trade-off for that tax deferral. And again, this is just another big difference between a brokerage account. That brokerage account example that we gave, you can move money in and out of a brokerage account no matter your age, and there's no penalty. And so just something else you have to be aware of. And then, so one other question that we get a lot is, okay, I like the sales pitch for that annuity. What are some alternatives, though? You're telling me there's high fees, it's not worth it. What else can we consider? And so, this is not exciting, but the biggest point we make is that you have a lot of options to diversify your investments. When you're saving in your IRAs and your brokerage accounts, you do not have to be 100% stocks, right? You can have some treasury bonds, you can have some CDs in there, you can have international stocks, lots of different investments that will protect you from the volatility of the stock market. And specifically, I think there's a pretty good case for what I'm just calling a bucket approach here, but that's, if you're retired, keeping a few years of living expenses in something very safe, short-term US Treasury bonds, something like that, so that you always see the short-term money that you'll need in something very safe, and hopefully help you not worry so much about the volatility of this other part of your portfolio that is in stocks and bonds. Also, most people have a Social Security benefit, and I had mentioned at the very start of this of the benefits of some amount of fixed income, and Social Security provides that for a lot of people. Social Security also has a couple really good benefits compared to annuities. One is that it's inflation adjusted. So if inflation comes, your Social Security will get a nice boost. We saw that, in the last few years here when there was some pretty good bumps in your Social Security benefit. Most annuities do not offer inflation protection, or at the very least, they'll offer, a flat 1 or 3%. They don't guarantee that it matches with inflation. And so for a lot for a lot of retirees, delaying Social Security to build up that biggest guaranteed benefit is kind of the best course of action for those that really want to have a big fixed income amount. And so before you consider dumping a lot of money into annuities in retirement, you should look at your plan and figure out if there is a reasonable way to delay Social Security. And then finally here, I put buffered funds listed. For those that watch our webinars regularly, you might know that buffered funds were in one of our webinars of investments we would never recommend, I think it was the title. And it is not something we recommend very often, but it is a new type of ETF out there that's trying to do what annuities do, but within a brokerage account without those kind of tax pitfalls. They still have high fees. Again, we still don't recommend them, but I think, gun to my head, if I had to pick either a buffered fund or some of these like indexed annuities, I think I'd pick a buffered fund. So that is, again, it's low on the list here, but something you should consider. And so thank you so much. I hope that's helpful. Just a very quick overview. I know we kind of glanced over a lot of topics. This can be a very, very in-depth topic. And so the only thing we leave you with is that please know we're happy to look at any specific annuity product that you're considering or being sold. Really the only way to get a specific answer for you is to dig into the details, find the fine print, find the fees. Hopefully this gives you an idea of what to look out for, but know that we're here to help you. If this is something you'd like to consider, or the ideas of annuities are attractive to you, something that we can help out with. So thank you so much. We'll be here standing by for questions if you have any. Otherwise, thank you and have a great weekend.